Today, I want to talk about something that does not always make headlines, but it quietly tells a lot about how households are actually doing. Insolvency. What happens when people cannot keep up with their debts anymore? And the timing feels relevant because the latest numbers just came out and they are pretty striking. In the first quarter of 2026, just over 37,000 Canadian filed for insolvency. That's the highest quarterly total since 2009, and it works out roughly 17 people filing every single hour. And that's not one-off blip. For all of 2025, the total came in at around 140,000 filing, the second highest annual number ever recorded, and the highest in about 16 years. That's close to 385 people a day on average across the country. That 16 years ago comparison matters because the last time number were anywhere near this level was right around 2008 and 9, the financial crisis. So before I go further, let's quickly cover what insolvency actually means because it's not just one thing. There are two main legal routes in Canada. One is bankruptcy, which most people have heard of. The other is consumer proposal, basically a negotiated settlement where you agree to pay creditors a portion of what you owe over a few years. And in exchange, they stop collecting effort and you get to keep your assets. These days, proposals are far the more common routes. Somewhere around 80% of filing are proposal, with the rest being bankruptcies. That's a pretty big shift from what it used to look like. It's also worth saying insolvency does not just mean I owe more than I own on paper. Most people who actually reach out for help are not doing it because they sat down and calculated their net worth. It's almost always a cash flow problem. They cannot make the monthly payments anymore. Full stop. By the way, I'm Ilham Ibrahim, a real estate agent here in the GTA. Whether you are buying your first home or selling to move to the next one, I'm right there with you the whole way. I make sure my clients always know what's happening next so nothing feels overwhelming. If that's ever something that you need, my info's in the description. Feel free to book a free chat with me. And that connects to something people in this field point out a lot. Insolvency is a lagging indicator because by the time someone actually files, they have usually been struggling for a year or two already. People try a bunch of other things first, consolidating debts, shifting balances around, sometimes even taking on new debts just to cover the old debts before they ever talk to a trustee. So the numbers we are seeing now reflects financial stress that's been building for a while, not something that just happened last month. And that's actually a key difference from what happened in 2008 and 9. Back then, it was one big sudden shock. The U.S. housing collapse sort of built out, things got bad fast, and then they got better fast too. This time, it looks more like a long, slow building wave that's going to play out over several years rather than one sharp spike. So what's different this time and why? A few things are stacking on top of each other. First, there is the hangover from a long stretch of historically low interest rate. That era encouraged a lot of borrowing and fueled the housing boom. And when home values are rising, people tend to take on more debt, line of credit, renovations, vehicles, you name it. And it's not just mortgage debts. On average, homeowners carry roughly double the non-mortgage unsecured debts that renters do. More credit cards, more car loans, more home equity lines. Owning a home tend to come with a lot of more financial moving parts. Then there is COVID. It's been a few years now, but a lot of people in service-based jobs, personal services, hospitality, parts of the entertainment industry took a real hit, and some never fully went back to those careers. On top of that, the early pandemic income support was taxable, so a chunk of people ended up with a surprise tax bills. layered on top of debts they've already built up. There's also this idea that the usual debt cleanup cycle just did not happen when it normally would have around the mid 2010. Because home values kept climbing, people who were getting stretched could just refinance and roll debts into their mortgage instead of dealing with it directly. So that pressure never got released. It just got carried forward. And now everything costs more. Grocery prices are up over 30% since 2019. And shelter costs, rent, mortgage payments, utilities, taxes have climbed close to 30% over the past 5 years. Those are the expenses people have the least flexibility to cut. You cannot really shop your way out of 30% jump in your grocery bill or your mortgage payments. Last piece, home prices have come down from their peak in a lot of markets, which means a lot of equity people were counting on as a cushion has shrunk or disappeared. At the same time, lenders have gotten more cautious. So even people who still have some equity are finding it harder to borrow against it. Okay, so that's the backdrop. Let's talk about the homeowners specifically, because that's the big story right now. Historically, insolvency trustee barely heard from homeowners. Owning a home was basically seen as a financial safety net in itself. That's changed. The share of new insolvency filings coming from homeowners has climbed noticeably over just the past couple of years. And trustees say homeowners' calls have gone from rare to daily occurrences. A big part of that is the mortgage renewal wave. Roughly 1.3 million mortgages, about a fifth of all the mortgages out there, are coming up for renewal over the next year or so. So many of them locked in back when rates were near rock bottom. For a lot of households, renewal means their payments jump by hundreds of dollars a month. For people who bought right at the bottom of the rate cycle with very little room in their budget, that increase can be even bigger, and it's landing on top of everything else I just talked about. Here's a wrinkle a lot of people don't know about, and it specifically affects anyone who owns a second property like a rental or investment condo. Consumer proposal, the simpler, more common option I mentioned earlier, have a cap on how much unsecured debt you can have to qualify. Right now, that cap is around $250,000, and it's expected to move up to somewhere near $325,000 eventually. So your mortgage on your primary home does not count toward that limit. But a mortgage on an investment property does count toward that cap. And most investment properties carry well over $250,000 in debt on their own. So just having that second property can push someone over the threshold and make them ineligible for the simple consumer proposal process. So what happened then? They get pushed into more complex court supervised version of the proposal, which has higher approval threshold from creditors and needs a judge to sign off. And here's the catch. If creditors reject that proposal, the person is automatically deemed bankrupt on the spot, and the home becomes part of the bankruptcy estate immediately. That's a pretty steep cliff edge. So a lot of people in that position end up having to sell the investment property or just walk away from it. A couple of newer factors before I wrap up. Online gambling keeps coming up as a growing piece of this. It's a big shift from a decade or two ago. Gambling now is a private, it's on your own phone, and there's no physical barrier like driving to a casino. People can run up significant losses on a credit card and cash advances without anyone around them even knowing it's happening. There is also a pipeline where younger people get into fantasy sports first. Then there are high interest installment loans. This is a side effect of tighter payday loan rules a few years back. Lenders shifted toward larger installment loans, often somewhere in the 7,000 or 18,000 plus range, at interest rate around 36 to 48%. Trustees say it's now common to see people carrying 2 or 3 of these loans at once, which add up to a lot of very expensive debt on top of everything else. So, pulling it all together, what's the takeaway? First, the consistent message from people in this field is that time makes debt problem worse, not better. The earlier someone talked to a licensed insolvency trustee, most offer a free initial consultations, the more options they actually have. But if they wait too long, some of these options might quickly disappear. Second point, in terms of where this is all headed, most signs point to a longer, more gradual climb in insolvencies over the next few years, rather than one dramatic spike like what happened in 2009. The number everyone is watching is employment. As long as that holds up, this stays a slow moving trend. If that starts to crank too, things could shift more quickly. That's it for the day, and thank you for watching, and I'll see you in the next video.